everyone, and welcome to one of our knowledge transfer sessions. Today we're going to be talking about basic tax thresholds for retirees. I was noticing in my practice over and over again that I was kind of answering the same questions to a lot of different people around taxes. And I was like, well, maybe there's a way I can create a cheat sheet that might be logical to a lot of people around taxes. So today's presentation is the attempt to create a cheat sheet and then try and justify it, basically. So, I would honestly say if you watch the first 2 minutes, you'll get 90% of the presentation, and then you're going to have like 30 minutes of going into the actual tax math, basically. So, watch what you find valuable to you. As usual, when we talk about taxes or anything, the presentation has to be treated as general in nature. A lot of the information here, I'm going to try and be as specific as I can and try and be on point. But, everyone's tax situation could be different. Tax laws can change. I don't file people's taxes for them. I do tax planning, which is a little different level of duty as well. Just real quick about myself. I have more than 17 years experience in the financial services industry. I run the retirement roadmap program for AAA out here in Washington State. I own my own practice, and I'm an independent financial advisor next to Bellevue, Washington. I'm a graduate of Washington State University, and I have pretty deep roots in Washington State in general. So when we talk about taxes, there's always a basic problem with the English language. The basic problem we always run into with the English language is, I can save you money on taxes. And it's usually really easy. All I have to do is take $10,000 from you, invest it, and give you $5,000 back. And I get to tell you, not only did I save you a lot of money in taxes, I saved you even more money than you realize because you get to deduct that loss against everything else. Yeah, you may have started with $10,000 and you ended up with $5,000, but whatever, I saved you a lot of money in taxes, right? And so we suggest you to avoid this trap, that you need to look at what your current tax situation is, what are your goals, how will your assets grow, and then look at reasonable alternatives. And so when we talk about tax strategies, this is the process we suggest to protect yourself from that basic tax trap. Now, in my practice, I do tax planning. That's the process of looking at someone's tax situation over 10, 20, 30 years. It's a less precise duty than tax filing, because tax filing is the very precise duty of doing your taxes with whatever government agency you're working with. My job is to actually do tax analysis on things for the future, so that when you get a tax filing, it's mostly in your favor at that point. So on to today's seminar, what we're going to talk about is we're going to spend a good chunk of time just kind of going over the basic cheat sheet. Here's the things I point out to you to learn about as a retiree. And then we're going to switch gears, and I'm going to go through the math on each of these different things. Social Security, Medicare IRMA and Affordable Care Act credits, net investment tax and Washington State capital gains tax, income taxes and capital gains rates just in general, and estate taxes. So a lot of actually topics to talk about, but luckily for you, I made a cheat sheet. And here's the retirement things that you kind of need to watch out for that might trigger extra taxation for you, okay? And in my world, taxation doesn't necessarily mean bad. Everyone wants to save money on taxes. But sometimes you trigger taxation because you've made a lot of money. And so that's, something to be aware of, is that just because something's triggering taxation for you, especially in retirement, you don't want to live on, $100 a month of income, right? You want to live on what you want to live on to be happy in life. And there's a certain amount of taxes that just naturally go with what you want to live on. But the problem is when you hit retirement, you're not, if you worked for a corporation forever, you're not filling out a W-4 and getting a W-2 at the end of the year where almost everything's pre-calculated for you and you just went to TurboTax or wherever you went and filed quickly. You're no longer getting to do that anymore. There's actually very specific tax events that can cause different taxation for you. And I would argue for a lot of people, for the first time in their life, they've actually had to pay attention to taxes in a way they never had to before. And those rules of thumb actually went away because during your working years, some of your rules of thumb was contribute money to your 401k, contribute money to a health savings account when those came along, make good investment choices around brokerage accounts. Those are good rules of thumb, but in retirement, it's a very different process because now you're spending all that money you saved, oftentimes tax deferred. And when we talk about spending, what we want to do is we want to talk about these are the spending thresholds where you're going to start triggering bonus taxes. Okay, and these thresholds. Once again, if you want to live on more money, you should just live on more money. I can always justify that in another video, but in general, this is where you go. Okay, I might want to look into this more. And so for healthcare, there's usually two scenarios that retirees run into: pre-65 and post-65. Pre-65, you're under a MEGI calculation. When I say MEGI, I mean Modified Adjusted Gross Income. And there are different ones. So whenever you hear MEGI or Modified Adjusted Gross Income, you should always go pause and go, which one? This is for the Affordable Care Act. Some people know it as Obamacare. And basically, if you're at a certain poverty threshold, you would get very significant tax credits from the U.S. government on your health insurance. And so if you're pre-65, you're generally going to see those tax credits phase out on you mostly once you're above these amounts of income. Now, after 65, you have something called Medicare IRMA. I always joke with myself, I actually don't know what IRMAA stands for. I just always call it Medicare IRMA. That's what everyone knows the acronym, but the actual term, it's what I've done retirement planning for years. I don't actually know the actual term. But Medicare IRMA is if you earn a certain amount of MEGI, a different MEGI calculation actually, of income, you're going to start triggering bonus taxes. And so for a single person, or in the case of joint, if you earn over $106,000 as a single person or $212,000 as a couple, you're going to start triggering bonus taxes. And for the majority of Americans, that's usually the sale of around like a home or a rental property. But, a lot of people live on whatever they want in retirement. I have people who live on more than $212,000 as a couple. And so, for that group, they're paying a little bit extra for Medicare IRMA. And then there's Social Security taxes. Now, if there's one calculation I always struggle with, it's Social Security taxes. It's not because you can't just calculate it based upon a very specific situation. The problem is if you, and we'll go through this on this presentation later, when you try and do changes to your calculation, when you try and add in, I want a $20,000 IRA withdrawal, or I want to sell some Microsoft stock and trigger some capital gains, you have to redo the Social Security calculation, and it actually can change the amount of Social Security that's taxable to you. And so when I was trying to create a rule of thumb for myself for Social Security, I was like, well, when do I have to worry I'm triggering extra taxation? And what you're seeing on the screen there is the general rule of combined income of 25 to 34K. And the way I always look at it is if you have IRA withdrawals, pension accounts, we're ignoring Social Security, but if you have other monies that's going to generate this level of taxation, you're probably going to make Social Security taxable to yourself at that point. And then you have to understand your basic income tax rates. You may have never had to pay attention to this. Like when you earn your wages at work, you just try and earn as much as you can. But in retirement, because you don't necessarily have a paycheck coming in, you get to create peaks and valleys around your tax situation. And, most people should be aiming for the 12% tax rate as like the literal sweet spot. Some people want to just live on more money. You should do that. But the 12% tax rate, if you're earning with the standard deduction $61,750 as a single person or $123,500 as a couple, you're going to be hitting the top of the 12% bracket. And ideally, even if you need to live on less money than these numbers, you should always be maximizing that bracket by doing Roth conversions or other things, because that's generally the lowest taxes anyone's ever going to pay on money in their life. Capital gains has different rules. People may not pay attention to capital gains rules very often because how often do you sell properties? But when you sell stock or properties, you can trigger bonus taxes. And so when we're talking about bonus taxes, we have federal net investment tax. I'm in Washington State, so we have Washington State capital gains tax we have to worry about. And then if you get over $500,000 of capital gains, you go from the 15% base rate to a 20% rate. In retirement, we have to worry about the end of retirement. What happens when someone passes away? So that means estate taxes, both federal and state. I find statistically the vast majority of people don't have to worry about federal, but state is a real big worry, especially here in Washington State. Gifting limits. If you're going to give $18,000 to someone, you don't have to worry. If you are a couple and you want to give $36,000 to someone, you don't have to worry. If you're two grandparents and you want to give money to your kid and their spouse, you can each give $36,000 to each of those people. So you can gift a lot of money. But once you gift past those numbers, you need to file paperwork. You actually don't trigger gift taxes until you get above the federal lifetime limits because it goes against your estate credit. But you can go ahead and just file the paperwork. It's a pain in the butt to file paperwork, but it's not hard. And you can gift millions of dollars to someone tax-free. And then if you're 70 and a half and older, you should be looking at qualified charitable distributions if you're charitably inclined, because you can actually gift money, significant amounts of money to charities, and it's a tax-free event. The IRS doesn't even consider it as income, so it's actually even better than tax-free in some situations. So just be aware of you can do that. And then the last thing in the cheat sheet is everyone has questions on required minimum distributions, and I'm creating another video on that one. It's not specifically a problem, but it can trigger taxes from before scenarios. So, we went through that cheat sheet pretty quickly, but those are kind of your basic tax thresholds you kind of have to worry about in retirement. And when you hit one of those, you're going to start triggering more taxes. And I have people who, everyone actually, within certain degrees, is going to hit those thresholds and trigger more taxes. It just, you don't know which ones are going to be relevant to you. So I go, here's your cheat sheet, here's everything to think about, and then the rest of this presentation is, let's really dive into each of these items, basically. And that's going to take a while. So if you want to just reread the cheat sheet and, rewatch that portion, I get it. But let's dive into the actual tax calculations. And Social Security is one of the hardest ones because it has this thing called combined income. So if you exceed a certain amount of income, you start to owe taxes on Social Security. And if you're below that, you don't owe any of those taxes. But the problem is when the math is calculated, it's based upon this thing called combined income. And Social Security itself only counts for half. So, if you only have, say, $40,000 of Social Security benefits, it only counts for half, or $20,000 in the calculation. And then you have to add in all the rest of the money, basically. And so as an example right here, I have a couple who have $80,000 in Social Security benefits. So their modified adjusted gross income calculation, remember Maggie, that thing I said before, is around $40,000. There's actually an internal calculation where $32,000 where they actually have a phase out. Then any amount over the $32,000 is where taxation begins, and that's $8,000 in this example, or $12,000 in this example. So in this case, $4,000 for this couple is added to their taxable income. But then their standard deduction kicks in. And when you do the math in here, they're living on $80,000 of Social Security benefits, 100% tax-free. Pretty cool. That's why we generally suggest delaying Social Security for retirees. It's not just a longevity credits, the 8% roll-up. It's this tax benefit where you can live on Social Security almost income tax-free. Now, when we do secondary things, remember I said it's hard to look at this when you do secondary things. What if I had a $40,000 IRA withdrawal for this couple? So it's a couple who want to live on $10,000 a month of income. Well, their Maggie calculation now is $80,000, 50% of Social Security and the IRA amount. $32,000 is the base amount when taxes are calculated on Social Security. $12,000 is over the base amount at 50%. Okay. So the taxable Social Security is $36,600, or 46% of the benefits in this calculation. I'd use a spreadsheet to do this math, by the way, or I'd use an online calculator. And their total taxable income is $76,600. The standard deduction on both these people is $32,300. So federal taxes for this situation is roughly $4,852 on $120,000, or 4% of their overall balance. And if this was just pure Social Security, there would actually be 0% taxation. Okay, so you'll notice, especially with couples, you can be living on significant amounts of money. And when we do the Social Security taxation, which is a little bit more complicated because of how they do the base amount component here, you can be on very, very low income tax rates. So you should always be paying attention to your Social Security, how to maximize it, my suggestion. And then layer on IRA withdrawals. So I try and get people to take IRA withdrawals earlier in retirement and Social Security later. Because Social Security can be very tax efficient. Just do the calculation on how much tax savings you get on Social Security amount. If you take it early and you want to do other things like Roth conversions, 0% capital gains, Affordable Care Act credits, lower Medicare IRMA costs. Social Security can get in the way because once it starts getting added to the calculation and you do other things, i.e. I take a whole bunch of money out and do a Roth conversion, Social Security is going to become taxable and it's less efficient at that point. But, if you're concerned about dying early, taking Social Security early can still make sense. All right, so let's talk about healthcare credits, a different modified adjusted gross income calculation. So if we look at the Affordable Care Act, it's a different MEGI calculation. MEGI for Affordable Care Act is going to look at, it's not going to include Social Security supplemental income. It's usually pretty close to your adjusted gross income, but there are some little things like non-taxable Social Security benefits, i.e. that couple lives on $80,000 of Social Security tax-free income-wise. Well, their MEGI calculation for the Affordable Care Act is going to show as $80,000. Tax-exempt interest is another thing that comes in here. And so the secondary component when we talk about the Affordable Care Act credits is every state has something called the premium tax credit eligibility income limits. And that's based upon the poverty levels in your state. And so you actually usually have to use a tool to figure out how much your tax credits can be. And that's why I did the tool. Actually, I looked up in Washington State what the 400% limit would be for my basic cheat sheet. Okay, because I know if you're under the 400%, you qualify for some credits. And if you're really under, you qualify for lots of credits. You usually get about half off if you're under 400%. And so ideally what you do is if you can control income pre-retirement, age 65, you can usually get about half off your health insurance if you can stay under this 400% FPL level. And I went and looked up the chart here for Washington State, where I am, and this is the basic level. So this is where I got the numbers I showed on the previous screen, the $51,520 for a single person, a couple 69,680, etc. This is the federal poverty level lines, basically. And so what your goal is to control your income and keep your income under these thresholds so that you can basically get half off your health insurance. And that can be pretty significant, especially for a couple. If you think about a couple in retirement pre-65, they're paying usually at least $1,000 a month for health insurance. And so if you can get half off per person, that's like $1,000 a month half off if you can control your incomes under that chart. So basically, the way I suggest you do this, especially in Washington State, create your login, put your information in there, and start playing around with the income amounts and seeing what it would cost for you outside of, making sure you have good health insurance, so that you can kind of figure out where can you save money using the Affordable Care Act pre-65. Now, post-65, we get to deal with Medicare IRMA, a new bonus tax situation, right? And so Medicare IRMA is an income-related adjustment where you are going to pay more for Medicare if you go over certain income thresholds, okay? And it's a sliding scale of premiums. And here's the 2025 sliding scale. And it looks 2 years back, by the way. So 2025 is looking at 2023 income. And when you look at this here, you're going to see for a single person, it's $106,000, and for a couple, it's $212,000. So if you're staying under those numbers, which if we look at the vast majority of Americans, they are. Now, if we're looking for people who retire in the Seattle-Bellevue area, they may not be. If you go over this amount, you're going to start triggering some bonus taxes. And I always tell people the bonus taxes are super annoying. And one of the bigger annoying portions of this is it's a cliff. Meaning if you go $1 over, you trigger the taxes. But if you want to live on an extra $2,000 a month in retirement, and it's going to cost you an extra $100 or $200 a month in Medicare IRMA, you're still living on $1,800 a month more than you would be if you tried to avoid Medicare IRMA. So, trying to run your retirement around Medicare IRMA, I don't think it makes a lot of sense. But you should, make sure that if you are close to it, you don't trigger going over. The other thing is the average person is going to have certain situations that is going to trigger this naturally. And make sure you appeal it when you have the chance, because people successfully appeal this all the time. Another area of taxes we have to worry about is what happens when you sell things. And we have something called net investment tax and Washington state capital gains tax. Net investment tax is how we paid for those Affordable Care Act credits. And basically, it's an extra 3.8% taxes on capital gains if you go over certain income thresholds. So like someone who works at Microsoft right now, they're earning a paycheck. They're going over these income thresholds. And as their RSUs vest, they're starting to trigger net investment tax. But in retirement, this is usually triggered by sale of stock or property. Now in Washington State, we have an additional 7% tax, which is a very similar limit. This one actually goes up a lot, is going up, whereas this originally started at $250, but it's gone up since then. Whereas net investment tax has not functionally gone up. And so, this is another area where if you trigger the sale of stocks and you start spending a whole bunch of money, or you trigger a big amount, you might trigger an extra 10.8% bonus taxation. The other thing when we talk about, how do you understand or how do you avoid taxes in retirement is just understanding your basic tax brackets. So remember how I said that, a couple, if you could stay at the 12% bracket, you would be in a really good spot. And this doesn't have the standard deduction in there. So everyone's getting to add their standard deduction to these numbers. If you're finding, there's a couple of my classic examples. I have couples all the time, especially in Eastern Washington, where I'm like, well, you can live on about $10,000 a month. Be a nice place to be, right? And they're like, well, I only need to live on $6,000. And they don't want to spend the extra $4,000. And that's totally fine. But what happens is they're not maximizing their 12% bracket. So you want to understand where your 12% bracket is and always try and maximize around that. Once you maximize around your 12% bracket, you're in really good shape tax-wise. If you get over 22%, that's also a time you're pretty sure you're going to start triggering those bonus taxations. So you should always kind of pay attention to the 22% bracket. So, because once you go blow past it, basically, you will typically trigger some level of bonus taxation on one of the different types of programs out there. Oops. Now, estate taxes are, the end of retirement problem. So someday we're all going to have this problem that we're going to pass away, and we have to worry about estate taxes at that time. And we always say that state is more problematic than federal, because for federal to really affect you, you need more than $13.61 million per person, and spouses get to keep their ex-spouses, their deceased spouses, limits. And so you get what's called portability. So it's really like $27 million for a couple. I would love to have this problem someday. Now, in 2025, Congress is supposed to lower these limits because the tax cuts that were under the first Trump administration are supposed to go away. We don't know if they're going to get extended or not, but even at $5.6 million, adjusted for inflation, it's still going to be significant amount of estate tax avoidance federally. So we pay attention to it. We don't worry about it very much for the average person here. And if you gift more than $18,000 per person, you're going to lower these limits because you're going to have to file paperwork. Now, in Washington State, we do have kind of a bigger estate tax problem. Paying taxes for some people, they don't consider it a problem because they feel they're supporting the public good. But I find most people that I deal with want to avoid taxes one way or the other ethically. And for Washington State, the problem is we don't have portability. So remember, portability means when one spouse passes, the other spouse gets to keep their exemption limits. Well, in Washington State, what happens is when one spouse passes, the other spouse inherits all their money, their IRAs, their 401ks, their brokerage accounts, the house, and everything. And then when it comes to estate taxes someday, it's just all on them and that big pool of money. And, the threshold's only about $2.193 million. And when you look at the prices of homes in Bellevue, Seattle, Spokane, we're starting to just make it so that the middle class just has to pay this now. And so what we're doing now is we're usually suggesting people talk to attorneys to start putting their assets in trusts. You do lose the step-up in basis when you put your assets in trust. And, I love my attorney friends, but they're not always very good at math. So just be aware that you do lose the step-up in basis when you gift your money to a trust typically. So that was a basic cheat sheet or basic overview of taxes and kind of things to watch out for and some basic math behind the scenes. I hope this is helpful. We're always trying to give these knowledge transfer videos. But if you have any further questions, feel free to email us. We love putting these out there. We love feedback. You're welcome to call our office or go to our website or watch any of our other videos. Our next presentation is going to be on required minimum distributions. So I hope that you find this all helpful. Thank you.